Gold bull runs aren't random. That's the thing most market commentary never quite says. Every major gold rally in the last 55 years has been preceded by the same set of macroeconomic conditions firing together. The conditions are documentable. The timing is consistent. And once you know what to look for, the pattern becomes hard to miss. There are 7 indicators. They have fired together exactly 4 times since 1971. Every one of those 4 times, gold went on a run that lasted between 3 and 9 years. In May of 2026, all 7 are firing again. This is what they are, where each one stands right now, and what the historical pattern says happens next. Quick note before we dive in, nothing on this channel is financial advice. We're covering the data, the history, and the news. Everything you watch is for educational purposes only. With that said, here we go. Before we get to the indicators, a quick foundation. When we say gold bull run, we mean a sustained multi-year period where the gold price rises faster than the prevailing inflation rate, driven by structural, not speculative, capital flows. There have been 4 of these since the United States closed the gold window in 1971. The first ran from 1971 to 1980. Gold went from $35 an ounce to over $850. That was the post-Bretton Woods reset, plus stagflation, plus the Iranian hostage crisis. The second ran from 1976 to 1980, overlapping the tail end of the first, silver alongside it, peaking on Silver Thursday. Some analysts count this as part of the first cycle. The third ran from 2001 to 2011. Gold went from around $250 to $1,900, driven by the dot-com bust, the financial crisis, and the early phase of central bank gold accumulation. The fourth, which most commentators are arguing about, started around 2018 and is still running. From roughly $1,200 to where we sit today, around $4,694 per ounce. That's a 3.5 times move in under 8 years. Every single one of those 4 bull runs started with the same 7 indicators firing together. Let me walk you through them. Indicator 1, negative real interest rates. Real rates means the nominal interest rate minus the inflation rate. When real rates are negative, meaning bonds yield less than the rate at which money is losing purchasing power, investors holding cash or bonds are losing value every day they hold them. Gold, which has no yield but no counterparty risk, becomes the obvious alternative. In 1971, real rates turned deeply negative through the Bretton Woods crisis. In 1976, they collapsed again under stagflation. In 2001, they dropped after the dot-com bust and stayed low through the 2010 commodity peak. In 2020, real rates went sharply negative during pandemic-era policy response and have stayed structurally low since. Today, the 10-year Treasury inflation-protected security yield sits in territory that, when adjusted for the real rate of household inflation rather than headline CPI, many institutional analysts consider effectively negative. Indicator 2. The dollar index peaks and starts rolling over. Gold is priced in dollars globally. When the dollar weakens, gold mechanically rises, even before any change in the actual demand for gold itself. Every major gold bull run was preceded by a multi-year peak in the US dollar index, followed by a sustained decline. In 1971, the dollar was overvalued under Bretton Woods. The system collapsed and the dollar fell roughly 30% over the following decade. In 1985, the Plaza Accord engineered another dollar decline. In 2002, after a multi-year strong dollar period, the index started a multi-year fall. Each of those declines coincided with gold's bull run. The 2022 dollar index peak above 114 is now multiple years old. The dollar has weakened against major reserve currencies meaningfully since. Indicator 2, firing. Indicator 3, sustained central bank gold buying. Central banks went from net sellers of gold in the 1990s, the so-called brown bottom period, to net buyers starting around 2010. The acceleration phase began in 2022, after Russian foreign currency reserves were sanctioned. That event taught every non-Western central bank a lesson about counterparty risk in dollar-denominated reserves. Since then, the pace of central bank gold accumulation has been the strongest in 50 years. According to the World Gold Council, central banks bought 244 tons of gold in the first quarter of 2026 alone. That's 17% higher than the previous quarter. The leading buyer was Poland, with 31 tons. Uzbekistan added 25. China continued its multi-year accumulation. Turkey, India, Saudi Arabia, and several smaller central banks each added. Indicator 4. The gold-silver ratio compresses. The gold-silver ratio is exactly what it sounds like. How many ounces of silver buys 1 ounce of gold? Historically, when gold bull runs mature, silver starts outperforming gold, and the ratio compresses. In 1980, the ratio dropped from over 40 to under 20 as silver ran from $6 to $50. In 2011, the ratio dropped from over 80 to roughly 30. In both cases, the late-cycle silver outperformance signaled that the broader precious metal bull run was real, not a one-asset rotation. Today, with gold at $4,694 and silver at $87, the ratio sits at roughly 54. It has been compressing for 14 straight months. Silver, by the Silver Institute's own accounting, gained 147% in 2025, outpacing gold meaningfully. Indicator 5. Yield curve inversion followed by a sharp re-steepening, signaling monetary easing on the way. When the yield on short-term treasuries rises above the yield on long-term treasuries, what's called an inversion, it has historically preceded most U.S. recessions. The Federal Reserve typically responds by cutting rates, which weakens the dollar, lowers real yields, and pushes capital toward gold. Every gold bull run since 1971 was preceded by a yield curve inversion within the prior 12 to 24 months. The 2022 to 2024 inversion was the deepest and longest in over 40 years. The curve has since uninverted, signaling the typical late-cycle transition. Indicator 6. A structural reset in the international monetary order. In 1971, it was the end of Bretton Woods. In 1979, it was the petrodollar deal collapsing in flux during the Iranian Revolution. In 2001, it was the early phase of post-Cold War realignment. In 2026, it is the multi-year acceleration of de-dollarization. BRICS Plus member states discussing alternative settlement currencies. Russian reserves sanctioned and never released. Multiple smaller central banks repatriating gold from London and New York vaults. China imposing strategic material export licensing on silver in January 2026. The world is, slowly, structurally, building monetary infrastructure that doesn't run through the US dollar. Gold sits at the center of that alternative. Indicator 7. Gold mining stocks start outperforming spot gold. When gold prices rise, mining stocks should rise faster, because miners have fixed costs and rising revenues mean expanding margins. In every prior gold bull run, the second derivative, mining stocks moving faster than the metal, was the signal that professional money was rotating into the trade. For most of 2024 and early 2025, mining stocks lagged spot gold significantly. That changed in mid-2025. By late 2025 and into 2026, the major mining indices began outpacing physical gold. This is the 7th indicator. It is also typically the one that fires last. So here we are, 7 indicators, every single one firing in May of 2026. The last time all 7 fired together was the start of the 2001 bull run. The time before that was 1976. The time before that was 1971. Each of those prior alignments produced a gold rally that ran for 3 to 9 years and delivered between 4 times and 24 times returns from the starting price. We are not predicting that the current run continues for 9 more years or delivers another 24 times move. We don't know what happens next. Pierre Lassonde, one of the most respected gold mining executives alive, argued earlier this week that the $40 trillion U.S. debt structure could push gold to $17,250 per ounce. ING's commodity team called $5,000 per ounce by year-end as a base case. Those are not our predictions. Those are the calls coming from the most credible institutional voices in the precious metals space, made in the last several days. What's worth watching in the next quarter? The Q2 World Gold Council Central Bank Report, whether the 244-ton pace from Q1 holds. If it accelerates, indicator 3 is going to escalate. The gold-silver ratio, whether it compresses below 50, that's the late-cycle confirmation signal. Real rates, whether the 10-year TIPS yield continues to drift lower against household inflation. Mining stock performance, whether the second derivative rotation continues or stalls. The pattern is clear, the data is firing, and the historical playbook is on the record. If you found this useful, subscribe and we'll keep tracking how it unfolds. We cover the data, the history, and the indicators almost nobody else is connecting. See you in the next one.